Hi, everybody. It's John King. It is February 17th of 2022, and I wanted to put out there an update on what's going on in the market. A lot of major changes are happening with the economy right now, with interest rates, and I want to continue to be your source of keeping you updated on everything you need to know. So first of all, inflation is the major problem. We're all feeling it right now. The price of cars, the price of gasoline, the price of everything you buy at the store. Inflation has gone up significantly, and it's higher than it's been since like the 1980s. And inflation was a major problem back then. And the federal government has a mandate to keep inflation in control. Ideally, they want inflation to be about 2% per year. For a long time, inflation's been super, super below that number. And now it's skyrocketed to over 7% inflation between what prices were at January of last year versus prices January of this year. And that is not sustainable. We all know in our pocketbooks that isn't sustainable. And the federal government's going to do their part to try and fix that. The problem is that anytime they jump in to try and fix something, they create what I like to call unintended consequences. So here's what we're dealing with. The government's number one tool to slow down inflation is to raise interest rates. Simplest way to think about that is if we rewind back to March of 2020, COVID shut down the economy, and the government was worried, saying, "Hey, we think that nobody's going to spend any money because they're going to kind of tighten up and be afraid, and so we need to spur spending, and therefore we are going to lower rates to make it cheap for people to borrow money, and they'll take that money and they'll spend it." Well, now we have to unwind that. We have to do the opposite because they're trying to make money more expensive so that people don't spend money on goods. And the less they spend on goods, the less demand there is, which should bring the prices down. And therefore, inflation will come back into normal levels. That's their goal. It's not that simple, though. One of the things that people are really concerned about is what is this going to do to the future of interest rates? And people are asking me, "Hey, John, I want to get my loan done before interest rates go up in March." The first thing you need to know, the Federal Reserve does not control mortgage rates. Now, they have influence over it because they do something called quantitative easing or quantitative tightening. Those are complicated, big words that simply say they actually are buyers of mortgage bonds. And a mortgage bond is created when you go get a home mortgage from me, and then we package it up and we sell it on the market. It becomes a bond. And the government can pour a whole bunch of money into buying mortgage bonds, which makes them cheaper. The rate goes down. Well, now the government's going to sell a whole bunch of mortgage bonds because that's one of the steps they have to follow to combat inflation and raise rates. They've got to sell the mortgage bonds they've been buying for the last 2 years. What that means is that they're pushing mortgage rates up, and they've already started doing that. Even before they've raised their short term rate, the Fed interest rate, they've pushed mortgage rates up because they're no longer a buyer of mortgage bonds. They've become a seller of them, which is meaning that their interest rates are pushing up. What does that mean to you? First of all, it means rates are still long term super good, but the reality is they're already pushing into the 4% range. For most people, they took out a loan and refinanced in 2020, 2021, and they're in the twos or threes, and you're best off staying where you're at. But equity is up significantly, and now is a good time to think about consolidating other debts. Because what the Fed's about to do is they're about to raise their interest rate, which covers short term debt. Specifically, it's going to impact your home equity lines of credit. It's going to impact your credit cards. So if you have a decent amount of credit card debt, or if you owe a lot of money on a home equity line of credit, we'd want to do a effective rate comparison. Essentially, it says, hey, you might owe $300,000 on your mortgage at 3.25%, but you owe $50,000 in credit cards that are at 25%. And that means your average interest rate between the two might be at 5.5 if we do a weighted average of the debt that you carry. And you can't write off any of that credit card debt. Plus, the interest rates are going to go up significantly in the next year on that credit card debt. So now is a good time to consolidate all of that together. And your 4 something percent interest rate is better than a 3 or 2 something percent on your mortgage and a 25% something on your credit cards. So that's really my advice to you right now is if you're in a position where you have a lot of unsecured debt, that interest rate is going to skyrocket in the coming year. Now is the time to take advantage of consolidating that debt. Aside from that, we're in for a wild ride this year. We've got the inflation issues wanting to cause interest rates to go up. We have the issues that are going on with Russia and Ukraine that are actually wanting to push interest rates down. And so that tug of war is going to continue. If a war breaks out, depending upon how things go, that actually can drive interest rates down, but it's absolutely going to create a lot of volatility and uncertainty. I do think housing prices are going to continue going up this year. I'm seeing a super, super hot market. I'm seeing a lot of buyers wanting to buy very few homes that are for sale, a repeat of what we saw in 2020 and what we saw in 2021. So if you're thinking about buying a home, it is still a better time to buy now because rates are going to continue going up and housing prices are going to continue going up. The last thing I'll leave you with is there is a silver lining. I think the federal government's waited too long to combat inflation, and inflation's gotten too high. And now they're going to have to pull out major interest rate increases to slow down inflation, but it's also going to slow down the economy a little bit more than what they're expecting it to, or what they're hoping that it does. And that's going to lead to a recession. I don't want you to be concerned because a recession doesn't cause a loss in housing prices typically. What a recession does do is it causes interest rates to come back down. So if you're in a position where maybe you're buying right now and you're worried that you missed the boat for low rates, I think we're going to have another window in the next 2 to 3 years. So whether you're buying now or refinancing to consolidate that debt, I think 2 to 3 years from now, we're going to be in a great position to get you a lower interest rate and a lower monthly payment if the Fed ends up causing recession like I think that it's going to happen. If you have any questions about this or anything else, give me a holler. I would love to help you out, and I hope you have an absolutely amazing day. Bye bye.